Hello and welcome to Investing Confidential. Inflation came down as predicted. Market reacted positive for one day, and then we reversed again. As we discussed, these rallies are never gonna be sustainable. All right, they're bear market rallies. This one lasted for a day. I don't know what the market's going to do today, but I'm going to tell you right now. I'm going to show you why this market reversed, and I'm going to show you why professional investors are scared. Yes, they are scared. And at the end of this, towards the end of this video, I'm going to show you a few charts to show you why they are really scared. Okay, let's jump into the CPI here. As you can see here, energy was lower. Okay, used cars were lower. That was positive. But on the other hand, rent, housing costs, food was higher. All right, now this is all going to reverse. But again, as I told you, people, we're going to show you that this is sticky. So let's look at the CPI in a chart perspective. Okay, look, big downward move. This should have been very positive. We should have had a big rally, but we didn't. And I'm going to tell you why. Because all of these things that were higher, okay, the components that were higher and the components that were lower, some of them are going to reverse, some of them are not. So what this means basically is, as we've been talking about, if you've been watching these videos, I've been telling you inflation's coming out, but it's sticky. It's very sticky. Where's inflation going to stick to? Right now, it's coming down. I don't know. It's below 7%. Where's it going to stick? Probably between 4.5% and 5%. Put that in perspective. That's very high. That's double the rate of inflation over the last 30 years. Very negative. This is why the Fed isn't going to stop anytime soon. Okay, like I told you, there is no pivot. The Fed is looking at wages, they're looking at this inflation, and they know that it's not going to end. Okay, it's coming down slightly, but it's going to be sticky. Look, food was higher, but I showed you in a previous chart, as you can see here, food is coming down all over the world. Okay, consumer demand, okay, is coming down. That means food demand is coming down. So that's going to reverse. I already told you about rents, as we can see here. Rents are already coming down. Okay, they were up a lot. As you can see here, they were up a lot. Now they're plummeting. Okay, in chart form, you could see what's going on in the housing market. The housing market is collapsing, folks. Okay, so rents are going to come down. So we're going to see reversal in the rent. Okay, but the big but here is China. Okay, China is emerging from COVID. The Chinese consumer has pulled back dramatically. It's been doing nothing. And now that the government's pumping in stimulus, we're going to see emergence. We're going to see a move from some of these Chinese-based commodities. Okay, look at energy. Okay, energy is going to go higher when the Chinese consumer gets back, starts traveling. We're going to see more activity. Energy prices are stabilizing. They're going to go higher. Look at copper. Okay, this is what we call Dr. Copper, very correlated to China, just starting to move back again. Okay, here we got iron ore. Okay, iron ore, very correlated to China. That's coming up again. So what does this all mean? It means that inflation is sticky, as we've been saying. Prices come up, prices come down. But because of all the shockwaves and everything else and all the garbage that's going on in the world, we are going to not, inflation is not going to come down to 2%, which is the Fed target. It's not going to come down to 3%. It's going to stick, and it's going to stick high for quite some time. That means these rates may not be going 75, 50, but they're going to do 25, 25, and they're going to keep going. And they may at some point have to go back to 50. I don't know. But okay, you could see here, the Fed never stops a hiking cycle. And this is one of the scary charts. The Fed never stops a hiking cycle till real rates are positive, okay? Real rates right now are still negative. What are real rates? 10-year bond, which is the base bond, minus inflation, okay? Inflation is 6%. The 10-year rates are 4, a little below 4. We are at negative interest rates. Until we get to positive rates, this Fed will not stop. Okay, this is why the market's scared. This is why these rallies won't last. Okay, these rates are going significantly higher. Okay, inflation fears. Okay, what's going to happen? The whole fear of inflation is going to turn sometime towards the end of next year to the worst case. And this is what we're going to begin to talk about. The worst case for the economy, the worst case for the stock market is deflation. And we're seeing signs of it. This is the beginning, but unfortunately, okay, as we move forward, we got this rate hiking cycle, and it's not going to stop anytime soon. But when it does, we are going to be in a situation that we should not be in, and that's going to be the worst case for the stock market. But right now, why is the market down, or why is the market sloppy? It's all about earnings season, and we discussed this before. It's the economy, it's earnings. The indicators are that the earnings season is going to be bad, folks, and the guidance is going to be worse. Remember, we discussed the earnings are one thing, but the guidance is more important. So far, the guidance out of JP Morgan and others is bad. It's not good, it's bad. Even BlackRock is concerned. Okay, look here. I mean, I don't like BlackRock, but they have the pulse on the market, and they are very concerned about their own business and about the earnings for U.S. companies going forward. Another leading indicator, ISM Services PMI. ISM means Institute for Supply Management, very reliable data. This is the Purchasing Manager Index. This is the leading indicator for earnings. Okay, it's pointing to lower earnings. Okay, another negative sentiment is small business. Again, we talked about small business being the engine of growth for this economy, for every economy. They do everything, right? They hire the most people, etc. Look at the sentiment. It's not good. And it's going lower, by the way. This is the beginning, okay? So I'm going to show you this is the trend. The trend is lower, and it's going to affect hiring. Here's small business hiring. Not good. This is where all the jobs come from. So these job numbers, I'm going to tell you again, I've been saying these job numbers are a joke. They mean nothing. They're outdated. It's laughable that the economy, that these job numbers are showing. Look, folks, you know how that you can tell me if I polled 1,000 people, they would tell me the real situation with the job, and it's not what the market says it is. Okay, it's absolute ridiculous that we have supposedly full employment. It's bull. It's not full employment because wages are too freaking low and they have to go higher, again, affecting inflation. Okay, let's look at the scary charts here. Household savings, okay, diminishing dramatically. And then you have consumer credit soaring. I hope those of you who are watching, if I give you one financial advice that I would give you, it's not buy stocks, bonds. It would be pay off your credit cards, pay off your any kind of credit line with it. These banks I'm going to show you what's happening with the banks, but you need to pay off your credit cards, okay? These are storm clouds for the economy, folks. Savings going down, credit soaring, and then you got people like Goldman Sachs, which dove into the consumer market. They got burned. They lost $3 billion on consumer loans. They're out. Okay, what does that mean? That means an indicator that credit is going to shrink. Okay, credit is going to shrink. You may get offered credit cards, but the rate's going to be 30%. And to get a decent rate, you have to have a FICO score of 800. So these banks are going to pull back, and that's not good for the economy. Okay, and here are the two biggest charts that should scare the hell out of you because it shows the top. Okay, here is Miami luxury real estate pending sales. Okay, folks, you ready? It's down 80%. This was the last hot market, okay? New York, all over. Miami was the number one hot market, never going to go down. Everyone's going to Florida. Well, the bubble has burst, okay? Pending sales, luxury sales, down 80%. Okay, real estate recession, we have hit it. It's beginning. It's already happening in parts of the country like Texas, Carolinas. It's hitting. Okay, all over. Housing leads the economy lower. Every time, if you look at when housing crashes, the economy crashes with it. And we're about to see we are beginnings, not the beginnings, yeah, we're probably in the second inning of a major crash in real estate. Look at mortgage applications. They're gone. They're at the low end. Okay, nobody's taking out mortgages for obvious reasons. Look at new home construction versus home sales plummeting. Okay, pointing to significantly lower prices. I don't care what these realtors tell you about inventory. I'm not going to go into my theories about real estate. You can look at some of my past videos. This is all garbage with these. Don't listen to the realtors. And here's the next chart. That people are scared. Okay, Tesla. Tesla's never cut prices, folks. They're significantly cutting price for the first time. Guess why? Demand is gone. Okay, their plants in China have been operating at very low capacity, so their supply, but their demand is gone. Okay, so you got Miami luxury real estate gone, Tesla gone, Fed hiking rates, demand is sinking, earnings season bad. I mean, if that's not a reason to sell all rallies, I don't know what. I don't have anything positive to say. I want to tell you, have a good weekend. It's Friday the 13th. I have no idea what the market's going to do. It could close up. It doesn't matter what it does because the trend is lower. The only thing moving here, and this is again, deflation indicator, is gold. And I don't believe it, but even Bitcoin. But gold is breaking out here, folks. Central banks are buying gold. You take a look at the chart. I wouldn't probably jump in here, but this is something you must own going forward. And for all you investors out there, be careful out there.